Thanks so much for taking the time out and joining in. What's the key reason for the 5% knock that we're seeing in the Chinese markets?
Well, I think right now we're dealing with a situation where you've got retail investors looking around at the economy in China. They're not seeing particularly great data. They've just gotten hit very hard with the currency devaluation over the last week. And so they're really sort of pulling back and retrenching right now. And so I think it's just overall negative sentiment right now more than anything else. So I'm not really surprised that we didn't see a bump, even though the government's putting more money back into the market.
Hey Ben, thanks so much for joining in. You know, the last time, Ben, we saw this kind of mayhem that was breaking out in the markets. We saw a lot of support that came in, but that came in at around 3,750 approximately on the Shanghai Composite. And currently, in fact, it's nearly at that level. What more measures can be done to save this market from falling apart? All right, I think we lost that. That line, but I think we have Michael Every as well, who joins us from Rabobank. Hi, Michael. Thanks so much for joining in. What are you making of the ongoing situation in the Chinese markets? Currently, they're down by close to around 4.5%. What's your sense? Have you got some reading in terms of what caused this?
Well, I think the clearest suggestion we have is that we were approaching a key technical level previously, after which the Chinese authorities have said they wouldn't be buying. So this is what happens when you have the government artificially trying to support the market up to a certain point. Once you get beyond that, everyone says time to sell. And we know we'd been optimistic, we got close to that point, and now everyone's trying to lock in gains in synchronization. It's very much a one-way market. Everyone buys in the same direction when they think the government are supporting them, and when they get to the level where they think the government isn't going to support them anymore, they all sell. So it just underlines the fact that the authorities can't dampen down volatility, and they can't permanently manage to reflate this market. All they can do is limit the downside to a certain extent.
You know, Michael, when China was moving one way up in the early part of 2015, all the experts we spoke to indicated that it's the retail investors, the local people who are pumping in money into the Chinese market, and not so much as incremental money coming through from foreign investors. On the way down, is it still the retail people who are booking their profits, or are you getting signs of institutional people reducing their holding in China, especially after the yuan devaluation as well?
Well, I don't think there's really clear data to actually draw that comparison very carefully. I think the broader picture you can see is that everyone's skeptical of the market at the moment, and I think if it weren't for the government guarantee, there'd be even more panic selling, quite frankly. But equally, even while that government guarantee presents a limit or a floor to how much downside we can get, as we're just seeing today, it also presents a firm ceiling. Unless they say they're going to buy in perpetuity and say 5,000 points is the target that they'll have for themselves rather than 4,000, at which point we can push all the way back up to there, and then everybody sells, leaving the government to basically take losses. So, they haven't really solved this underlying dilemma that in looking at key ratios such as the PE ratio or the price to book value, it's still a very, very overpriced market in many areas, and we haven't done really anything to resolve that on an underlying basis.
All right, Michael, just hold on to that thought. Let's get in Ben as well. Hi, Ben. Thanks so much for joining back with us. I think that line snapped the previous time. So I'm putting the same question across to you. We saw a lot of supportive measures that came in, and that prevented the Chinese market from really slipping below that 3,700, went to around 3,500 and found support there. Now, if this gets pulled off, do you think, in fact, we are ripe for a full-fledged sell-off?
Well, I think if you look at the market and you look at sort of where stocks are positioned right now in terms of their pricing, the reality is we're still quite high compared to where we were a year ago. And I think if you look at the PE ratios of a lot of the companies, you could make the case that they're still very overvalued. And that, coupled with the fact that I think retail investors now are very skittish about the market, I could absolutely see the markets heading lower.
Okay. Ben, just stay on. We've also got Michael in conversation with us. Michael, with the weakness in China, does India look relatively better? Do you see any kind of trade taking place because money is now being pulled out of China in any way benefiting India?
Not really. Not directly. I think there are very, very few individuals who say, I'm taking my money out of China and putting it into India, because as we were saying, a lot of it's being driven by local investment rather than foreigners. And if you have been burned in China, you're not necessarily going to turn around and say, I'm looking for another emerging Asian giant to put my money into straight away. So that direct shift isn't necessarily going to happen. Having said that, nearly everything bad that's happening in China in terms of, dragging down commodity prices, etc., actually is a benefit to India. And ironically, a lot of this, economic strain that we're seeing in China could indirectly actually be a positive for India. So that could, to an extent, see a bid to Indian equities, even though from a clear one-to-one shift perspective, it isn't going to happen.
Right, Ben, let's put that same question across to you then. In fact, the Chinese markets have been going down. At one point of time, we had an inverse relation that was playing out between the Indian and the Chinese markets. But now, in fact, it appears that the Indian markets are following suit, at least temporary. What's your take? Chinese markets not faring too good. Could we see some shift coming into the Indian markets?
Well, I mean, I think the challenge, and I sort of echo the same response here, it's the retail investors that are sort of driving the market in China. And the typical profile of that person is not going to be somebody who's going to be taking their money and then investing in Indian stocks. They're going to be looking at real estate in China or maybe trying to offshore their money to real estate investments overseas. What I do think is going to happen is we're going to see a lot of Chinese companies really coming under pressure now, having trouble paying their debts, and that might cause some investors that otherwise would have been looking at investing in manufacturing or other industrial companies in China, maybe looking at India as an alternative. So in that sense, there could be a benefit, but I don't think you're going to see an uptick necessarily in India's stock markets because of this.
Okay. Ben, the Chinese currency yuan has fallen by nearly 3% in the last 5 trading sessions. We understand that the government there is trying to support the currency. But what's the view now on the yuan? Do you see a further decline or a further fall in the yuan? What's the view, say, for the next 3 months or 6 months?
Yeah, I mean, I think we could see it continuing to fall a little bit over the next 3 to 6 months, but I don't think we're in for more drastic days ahead. I think we've sort of hit the threshold where the government's going to be looking at things and saying, look, if it goes too much lower, there's going to be panic. And the nice thing is they have a tremendous amount of foreign reserves. They have a lot of control over state banks, so they can buy back currency as needed to sort of stabilize the floor. So I think we might see maybe a slow decline over the next few months, but nothing major.
All right, Michael, could you give us your top 3 asset picks at this point of time? Would you be looking at gold? Is there any currency that you'll be looking to hide into? Because equity markets, actually, they've been quite wobbly.
Well, gold I prefer to have in my teeth than in my pocket, to be honest with you. And in terms of asset classes in general, right now I think one of the safest things to be in is cash. I think we've got an extremely volatile global backdrop, enormous uncertainty on any number of different fronts. And frankly, what we're seeing in China really is just the start of what I think is going to be a much broader period of global turbulence. So I think there isn't anything wrong with just taking a back seat and watching to see where the dust settles.
All right, now it's a 6% fall in the Chinese markets. Michael, what impact will this have on other commodities? You touched briefly about gold, but what about the other commodities?
Well, it's negative for nearly all of them, really. Pretty much across the board. So I don't think we should be too surprised to see selling pressure that we've already been experiencing accelerate. Having said that, though, bear in mind that we are already starting to get used to this kind of volatility in the Chinese markets. Today's a particularly bad day again, really underlying that structurally China hasn't dealt with the overpricing of the market. But at the same time, we've seen plenty of days over the past couple of months with exactly this kind of volatility, and I don't think one fresh one is going to change the overall dynamic.
Okay, Michael. All right, that's the opinion coming in from 2 experts, Ben Cavender of CMR as well as Michael Every of Rabobank. Thanks so much, guys, for joining in. By the way, keep your eye out on the markets. The Nifty, as we pointed out, is below that 8450 mark, but it's the banks which is selling off very, very aggressively. So the Bank Nifty is now down more than 1% from the day's high. Now down 1% as we speak. And the key drags include something like a PNB, which is down nearly 3% Kotak Mahindra Bank as well as ICICI Bank have slipped nearly 1.5% to 2%. As you can see, the contribution plate, most of the weaknesses right now in the private sector.